Helen Thomas and the CDFM Study Group. Today I'm going to be covering CDFM Module 3.3, the Accounting and Finance section, and I'm going to be focusing on the accounting portion. I will be reviewing the 2018 study guide from the American Society of Military Comptrollers, CDFM study guide. All right, we'll begin on page 3.3.5, which is the accounting introduction. So in federal or the Department of Defense, there are three types of accounting. We have budgetary, financial, or proprietary, and managerial cost accounting. So remember, proprietary and financial is the same type of accounting. So budgetary accounting, proprietary or financial, and managerial cost accounting. And we're going to look at each one of those. On page 7, it mentions the three types of federal financial statements. So think of accounting. It's not exactly the same as the civilian accounting statements, but they're similar enough. So the three types of federal financial statements are the balance sheet, the statement of net costs, and the statement of change in net position, which is exactly what it is. It shows you the change from one statement to the next in the net position. So there are examples of the balance sheet on page 8, the statement of net costs on page 9, and a government statement of changes in net position on page 10. Now, I'm not going to be going through that specific because the examples are there for you. I want to jump to page 13. Again, the key to success on this exam is understanding the processes, the key players involved in that process, and their functions, their documents. What do they do in that process? So on page 13, some of the individuals or organizations you've already heard about is OMB, Office of Management and Budget. So you start with Congress. Congress has the Congressional Budget Office. The executive branch or the president has the Office of Management and Budget. The Department of Defense has the USD Comptroller, Undersecretary of Defense Comptroller. We also have another key player that continuously comes up in the study guide is the GAO, the Government Accountability Office. As studying, you want to pause and say, who are the GAO? The Government Accountability Office is an independent auditing agency that works directly for Congress. Remember earlier we talked about Congress placing limitations and guidelines on the appropriation. Well, if no one's checking, we pretty much can do what we want with the funds. However, we have the GAO. They work independently directly for Congress to ensure that we are following the limitations Congress instated. Another key player on page 13 is the Department of Treasury. That's the federal bank. That's where we get our money to spend, to obligate, to commit. So the Department of Treasury, remember when Congress appropriates the money, two things happen. First thing, Office of Management and Budget begins the apportionment process. So every time you hear apportionment, you think of OMB. And the second thing that happened is the Department of Treasury issues the Treasury warrant saying, hey, we've got an approved law, appropriation law in place. Your accounts are set up. You can begin to spend. And in the accounting section, you also have the Federal Accounting Standards Advisory Board that establishes the accounting rules that we have to adhere to. So the GAAP, which is also that generally accepted accounting principles, again, we can have all these rules, guidelines, and principle standards in place, but if no one's verifying, checking to ensure that we follow them, then chances are people are not. So we do have those checks and balances. So you have the boards on page 14 that you can look at, but I am going to be jumping to page 15, which is the implementation of these accounting standards that are established, the GAAP, Generally Accepted Accounting Principles. So you have the OMB that issues OMB circular. It's mentioned on page 15, and you, like I said, you have to read the information And what I'm saying, and ensure that I'm not giving you wrong information, you can look on page 15 on number 1, and you see OMB Circular A136 deals with these accounting principles. So that's where you'll go to get your guidelines. The GAO formulates the generally accepted government auditing standards. So under each section, if you're dealing with finance, we talked about DoD FMR 7000.14R. Now we're under accounting. It talks about OMB Circular A136, the GAO, the GAS is the acronym, the Generally Accepted Government Auditing Standards, and then the Department of Treasury, again, guidelines given under OMB Circular A136. So they have the federal accounting standards listed on page 16, 17. Then it's also mentioned again on a chart all the way up to page 19. So I'm not going to go through each one of those. I need to get to the meat and potatoes of this section. So what I want to do is to go over the types of government funds on page 24. We have what most of us deal with is appropriated funds, which is what we get annually for each fiscal year. You got reimbursable funds, you have revolving funds. Remember when we talked about the working capital fund, the no year does not expire, those are revolving. Trust funds and NAF, non-appropriated. Most of your MWR on an installation operate under NAF funding. The categories of appropriation we've already discussed, so don't let this stuff confuse you. Page 25, you have annual appropriations, multi-year, such as your RDT&E, procurement, Milcon, shipbuilding, conversion, Navy. If they're more than a year, then those are multi-year appropriation. You also have your no-year appropriation, your X funds, or your most popular one, working capital funds. And some are permanent, indefinite appropriations. And it gives an example as your interest and your debt, those appropriations that are permanent. So that just means they don't have to go back to Congress each year. All right, I always love charts because it gives you a quick snapshot of what they're talking about. So page 26 at the top, table 332, are the most popular appropriations that we deal with and their life cycle. And we've talked about this earlier when we talk about phase 1, phase 2, and phase 3. They're current, expired, and then they're closed. So the dates that are on page 26 here are when they are open or current. So we deal with MILPERS and O&M are 1 year appropriation, RDT&E 2 years, procurement 3 years, shipbuilding and conversion procurement is 5 years, and military constructions is another 5-year appropriation. That means you can have new obligations in each one of those timelines. And then we talked about expiration. So after those timelines are up, every appropriation remain expired for an additional 5 years. So 5 years, when they are expired, the only thing we can do is make adjustments. We can't make any new obligations when they are expired. So all I'm doing is recapping things that I've already covered in the past. And then when the appropriation is closed, those funds are removed from our accountability and placed in the miscellaneous receipts account at the Treasury. So obligations and obligating documents on page 27. We touched on contracts, MIPERS, military interdepartmental purchase requests. Under MIPERS, on the bottom of page 27, a MIPER can either be a project order or an Economy Act order, and there's a difference between both. Let me see, and see it's not covered in detail here, but I know it's in a previous section, they went into the project order, and I think it's module 1, the earlier part of module 1, project order and Economic Act order. So if it's a project, that means once I issue those funds can cross fiscal years. I don't have to deobligate the funds. That means the DoD has detailed instructions, and those project If you do a MIPR and you put it's a project order, that means I don't have to deobligate the funds at the end of the fiscal year. If it is an Economy Act order, those funds, once it crosses the fiscal year, I am required to deobligate the remaining funds. So make sure you know the difference between a project order and Economy Act order. Your meat and potatoes of the accounting section is covered on page 3328, that chart. Because if you look on the chart, you see the account codes ranging from 1,000 to 8,000. And then it goes the title and the type of normal balance you'll have for that accounting. So again, we are on the bottom of page 28, where it goes into the chart of accounts. Yes, memorize this chart, because this will help you so much when you have a formula that you need to know, because on the exam, they will not give you the formula and how to calculate the balance sheet or how to do the statement of net cost. You have to remember. So what I'm going to show you is an easy way to remember the formulas just by knowing this chart. So if again, go referring back to the chart on the bottom of page 28, the accounts 1,000, 2,000, 3,000. You see it's assets, liability, and net position. But before we go there, so keep your hand on that chart because we're going to come back and I'm going to show you how to use that chart. So on page 29, remember we said the first type of accounting is budgetary accounting. So it's simply when I keep track of the budget. So resources equal the status of that resources. It must balance. Equal signs mean it must balance. And if you go back to the chart, you see all my 4,000 numbers deal with my budgetary. So when you're doing budgetary accounting, that means if I get a list of numbers that start with 4, I know that those are the numbers or values that I have to use to do my calculation. One side must equal the other side. So budgetary, everything that starts with a 4,000 is used to do your budgetary accounting. So if you look on the example given on the bottom of page 29, they have the 4119 other appropriations realized. So I get other appropriations for 1,000, and then the 44850 rather unapportioned authority. That means I got the money, now I have the authority. It balances off on the debit and credit for 1,000. So keeping your hands on page 28 with that chart, if you flip to page 30, it talks about proprietary accounting. What was another name I gave for proprietary? If you look on that chart, or under the chart, you see financial accounting. So it's the same thing. So the first formula, so other than resources equals status of resources for your budgetary, now your proprietary accounting, the first formula under proprietary is your balance sheet. On the balance sheet, the formula is assets equal liabilities plus net position. But guess what? If you flip back to your chart, you see assets are your 1,000, liability is your 2,000 numbers, and your net position is your 3,000 numbers. So you already have them in order. So the formula is assets, my 1,000 number, equal my 2,000 numbers plus my 3,000 numbers. That's where you get the balance. So the balance sheet, assets equal liability plus net position. So if I know, so that means I can get a list of numbers that start with 1, 2,000, 3, and even 4, because we did budgetary accounting. And I will know if it starts with a 4 is what I use for budgetary. If it starts with a 1, it's an asset. If it starts with a 2, it's a liability. If it starts with a 3, it's net position. Balance sheet says assets equal liability plus net position. So if they give me a bunch of numbers, I pull out the numbers, and then when I'm done, one side must equal the other. The other formula is the statement of net cost. Expenses minus revenue equals the net cost of position. So I'm still on page 30. Now I'm flipping back to page 28, that chart. Again, the statement of net position is expenses minus revenue. If you go back to the chart, you see my revenue is 5,000 and my expenses is my 6,000 number. So if I get a list of numbers starting from 1, 2, 3, 4, 5, 6, I know in order to calculate my statement of net cost, I need to take all the numbers that start with 6,000, subtract that from the numbers that start with 5,000, and that will give me my statement of net cost. Expenses minus revenue equal net cost of operation. So that's the best way how I can help you to remember the formulas, is to learn the chart in order to know 1,000 is asset, 2,000 liability, 3,000 net position, 4,000 budgetary, 5,000 revenue, 6,000 expenses. Then you have 7,000 gains and losses, and your miscellaneous memorandum is 8,000. Okay, so that's proprietary account. So budgetary and proprietary. So on page 3132, what it's doing is once Congress appropriates the money, they're showing you the type of entry that goes in the accounting system. And the best way how to remember this is, okay, let's see, the first transaction, once Congress appropriates the money, it requires a proprietary and a budgetary transaction. Everything else is budgetary transactions until you get to the point where you receive items. So Congress, so let's go through page 31 so I can show it. Transaction 1, appropriations. Then I say two things happen. Treasury issues the Treasury warrant, and OMB begins the apportionment process. So it requires an accounting transaction or documentation when OMB in transaction 2 does the apportionment. That requires a budgetary entry. Transaction 3, DOD issues allotment. That's a budgetary entry. Transaction 4, now we commit the funds. That's the budgetary entry. Going over to page 32. Transaction 5, obligation. So remember, we commit and we obligate. So Congress appropriated apportionments, DOD issues allotment, we commit, and we obligate funds. Obligation of funds. That means I enter into a contract to purchase materials. Transaction number 6, receipt of the materials that we order. When we receive the items, that is still a budgetary entry, but you also have to do a series of proprietary entries. There are 3 different proprietary entries. So even if you don't know what the actual entries are, know that there are 3 different proprietary entries once you receive the items. And once we pay the invoice on page 33, that requires budgetary and proprietary. So the first one was budget proprietary, everything else, transaction 2, 3, 4, 5 is budgetary, 6 is budgetary, and 3 proprietary, and 7 is budgetary proprietary, just meaning what type of transaction. So on the chart on page 28, again, it shows you the normal balance. All you do there is when you learn 1,000, assets normally has a debit balance. Liabilities normally has a credit. Net position normally has a credit. So you learn it all together and repeat it together every time you study. So they have a ledger on page 34 to show you how you do the T ledgers of the transaction of what we discussed earlier. On page 35, they also wrote out the general ledger, but let me see. So what I want to show you, like on page, now when we go back to page 36, you see an example of a balance sheet. Remember, assets, all my 1,000 numbers equal liability plus net position. So all my 2,000, 3,000 numbers, when I add them up together with the assets and I compare them, they should equal. Statement of budgetary resources. That was, remember, budgetary accounting, resources equals status of resources. Balance sheet, assets equal liability plus net position. Statement of net cost is expenses minus revenue equals net cost. All right, so I'm not going to beat that up too much. to make sure that you understand. But that's the meat and potatoes of this section, is making sure that you understand how to do the calculation. So the third type of accounting is on page 47. And 47 is managerial cost accounting. So as supervisors, managers, we take this data that we have of the accounting and we do managerial cost accounting. So some of the things that managers look at is not just the cost. We want to know what's the direct cost, indirect cost, what's the long-term effect. There are different things as a supervisor or manager that we want to know. So there are two types of ratio analysis used in federal accounting. You have current ratio and quick ratio, and you need to know the difference between both. So the current ratio measures the entity's ability to meet its obligation, to pay its bill. And if you look at the formula, it says current ratio is cash plus accounts receivable plus your inventory. Everything that you own, account receivable is money that we expect to come back in, and our cash on hand divided by what we owe, our current liability. That will give us our liquidity or ability to pay our bills based on cash, accounts receivable, inventory divided by current liabilities. Quick ratio is I want to know my cash and accounts receivable with no inventory divided by my current liability. The quick ratio is also called the asset test ratio. That's mentioned on page 49. So the test of an entity's immediate solvency is you use the quick ratio. That means I don't have time to do inventory or making sure what my inventory values. It's my quick, if I need to quickly pay off a bill, my solvency asset test ratio is a cash plus accounts receivable divided by current liability. So that's the end of that section. If you look on page 51, page 51, that is a great exercise for you to do, because you will see, for instance, on exercise 331, where it talks about, it gives you the account number. Now you have to first state whether it's budgetary or proprietary. And if it doesn't start with a 4, it's proprietary, because all the 4s are budgetary. The second question is asked if the account is an asset, a liability, or net position. You already know asset must start with a 1, liability with a 2, net position is with a 3. And the third thing, it shows whether the normal balance is credit, debit, or it could be both. Then at the bottom, exercise 332 is talking about the things that happen once Congress appropriates the money. What type of accounting entry does it require? Does it require proprietary or budgetary or both? So ensure that you do that section. And then if you have questions, please leave a comment under this video and I will get back with you on the response. Because if you have a question, someone else may have the same question also. So this concludes CDFM Module 3.3, the accounting section of the 2018 study guide. So be sure to subscribe and give the link to others, and I will see you guys again next time.